So perfect. We are on. So let's start with the introduction. Matthew, so tell me a little bit about yourself, your background, and your career progression.
Cool. Thanks for having me. Yep. So I'm Matthew Lean. I'm a financial advisor in Edinburgh. I work for a firm called Executive Wealth Services. We're pretty much as central in Edinburgh as you can get, just on Thistle Street. And what do we do day in, day out? It's sort of investment planning, retirement planning, estate planning, those types of things, and also insurance products. So all the good stuff like life insurance, income protection, critical illness, all things that people probably don't think about but are very important. How did I get into financial advice or
Mm-hmm.
financial services? Like a lot of people, it seems, I actually fell into it. It's not something that I'd set out to do. I actually studied forensic and analytical science at university, so it's it's a bit of a jump. There's a lot of crossover, don't get me wrong, in terms of analytical thinking and critical thinking,
Uh-huh.
but really it was just a family friend had a position at his company and said, "Do you want to try it out?" And I said yes, rather naively. Didn't really know anything about it. I started out the most kind of basic admin. My role was trainee paraplanner. I guess it's akin to being a
Mm-hmm.
paralegal if you were to look at it in lawyer speak. And that really just meant I was doing admin jobs, report writing, assisting the financial planner with cases, and setting out the advice on, well, actually, here's client A, and they want to get from here to here, and making sure that
Mm-hmm.
everything's compliant, because everything we do is obviously very heavily regulated. Started there in January 2018, so getting on in my career a little bit now. And while I was
Yeah.
working full time and doing that kind of introductory role, I also studied after work for my qualifications to work towards becoming a financial advisor. And I've been
Mm-hmm.
officially, if you like, a financial advisor, and signed off since January 2023.
Nice. Yeah. And what would you say on that? So first of all, like, what is a financial planner, let's say, and then how a financial planner benefit someone?
Yeah, okay. So I guess in simple terms, a financial planner works with both individuals and businesses. And really what they
Mm-hmm.
do is they try and get a good understanding of their needs. So obviously a business's needs is going to be different to an individual's needs. But really the first step is to do a discovery meeting, really get to know them. And essentially what you're doing is helping them plan for the future. Anytime we give financial advice in the UK, it's tailored specifically to that client. So we
Yeah.
really need to dig down and see, well, actually, what is important to you, because what's important to you might not be important to the next person that comes in. Then we sit down and say, well, actually, what are your goals? Are they achievable? And how can help you get there? And it's not
Yeah.
really all about money. I think a lot of people think, well, actually, you come in, you have your review, and you say, well, it's great, we're up 5% this year, 6%. That's all well and good, but it's actually the human interaction and being able to trust the person you're working with. There's more to financial advice than purely just saying you're up or you're down. It's, well, actually, can we use the money and the assets you have to
Yeah.
facilitate the life that you want to lead? And that's probably the most important part of it.
Yeah. A lot of people think of financial planners that, as you said, like you just give financial advice and people want it to go up over time, and that's pretty much it. But I
Yeah,
think it's yeah.
so
Sorry.
certainly that helps, but I mean, a real financial planner doesn't just look at the numbers. It's lifestyle financial planning, it's goal setting, it's keeping clients accountable, those types of things. Whereas previously, especially back in the day, I think it was a lot more transactional. Now,
Hmm.
a good financial planner will help with things like cash flow planning. So, I mean, we can cover a lot of things as a financial planner. No two clients are the same, so it could be a young client coming in saying, well, actually, I want to save money for a house deposit. Okay, their needs are going to be different to somebody who's saving for retirement. But at the end of the day, it's strategizing, isn't it? It's understanding the person and strategizing and hopefully creating good
Yeah.
client outcomes at the end of it. So there's more to it. And I think that's probably the thing I like the most is you don't know who's going to be sitting across from you. You
Yeah.
get a phone call or an email saying, I'm looking for financial advice. A lot of people actually don't know what they're looking for. A good financial advisor will look at the bigger picture and so take a holistic view, if you like. So you could come and say, well, actually, Matthew, I'd like to focus on retirement planning. Okay,
Hmm.
that's one thing, but we'd say, well, actually, what about this? What about your family circumstances? What's your income expenditure? Maybe there's a gaping hole over here that we should fix before we focus on here. So it's really about taking a step back and taking
Hmm.
the bigger picture view.
Yeah. Yeah, later on we will talk about goal setting, and I think that's important, and especially as a financial advisor. Yeah, like set goals for the client, and then from there, you can kind of move forward. So you go one step back, or like two steps back, one step forward.
Yeah, exactly. I mean, you need to have a goal to set out the plan. If you don't have a target to aim for, then how can you say, well, I'm on track or I'm not on track? Some
Yeah.
don't get me wrong, some people might not have any goals when they come in, but by the end of the conversation, a good financial advisor will ask searching questions that make you think, well, actually, what is important to me in my life? What do I want to achieve
Yeah.
in retirement? Those types of questions, and then that's unlocks something in
Yeah.
clients' brains. And I guess a lot of the time, it's really people just want a bit of clarity. And if a good financial advisor can ask the right questions, help them
Yeah.
set the goals, then they have financial clarity. Because otherwise, it's like, okay, we've got this pot of money over here invested, it's growing, great, but really, what's the purpose of this? You need to have the purpose, otherwise it's just going to sit there and do nothing,
Do nothing.
potentially.
Yeah. No, interesting. Let's get into investing. Okay. So, what is the best way you would describe or explain investing to a young person who wants to kind of start investing their money?
Yeah, I guess the key is to keep it simple. And financial services can be full of jargon. So I guess in simple terms, I would say that investing is you take your money, you invest it into an asset, or you buy something, you put money into it in the hope that over time you get a return on your money. That's the most
Yeah.
distilled way of thinking about it, I think. What is an asset? Well, an asset could be shares in a company, it could be a property, like a physical property like a block of flats or whatnot, or it could be what they call bonds as well. So, I mean, a bond is just an IOU given in return for loaning money to a company. Again, there's the jargon coming out. I should have avoided that, but those are three different asset classes. So you'd put your money into those things in the hope that over the long term you get something back. Why is that important? Really, the largest killer of wealth is inflation. It's the rising costs of goods and services. So if your money
Hmm.
is sitting in the bank, you might think it's safe. It's a common thing that people think, well, actually, my money's in the bank, it's safe. It's not. You're opening yourself to inflation risk. And obviously, if you're young, 18 to 25, and you're thinking, well, actually, I'll build this money, put it aside from retirement, and you keep it in cash, inflation's just going to erode the spending power of your money as time goes on. So really, you should be investing for the long-term growth. It's just a concept that's hard to think about because it's you can't really see it. Often, well, I guess the main thing people think about in the UK is the price of Freddo's going up. They used to be 10p, now they're what, like 50p or call it. So that's
Yeah.
inflation, isn't it?
Yeah, no, for sure. I do agree, but it's interesting because we will cover like financial literacy later on. And it's for me, what's interesting is that like with inflation, you don't understand it. And like for example, like housing and rent have gone up so much. So I have been living in Edinburgh since 2014, and when I could pay for my rent £500, now it's extortionate.
Yeah, you just
Yeah,
need to get your money working harder for you.
yeah,
But we say working harder and making a return. It's very important to understand that returns aren't guaranteed, of course. You need to take some
yeah,
risk to get the reward. So, what I would say to anyone listening to this podcast, if you are young and you're thinking, well, actually, I need to go and invest, it depends on your circumstances. So, investing should be long term. We'd typically say
yeah,
for at least 5 years, and it's just because things are particularly volatile. So you need to give it some time to grow. Things aren't going to happen overnight. So, say for example, you mentioned paying rent and has increased with inflation. True, unfortunately, but that might be a reason for people wanting to buy their first property, and it's okay. Well, I need to build up a deposit to put towards
mhm,
this property. If you're thinking about saving for the next maybe 1, 2, 3 years, don't invest that money. You want it to be held somewhere on the bank or a high interest savings account, just so you've got that security that you know what's going to be. For example, if you're to invest, say 50,000, it could go up in the next 1 or 2 years, but equally you could lose some, and you'd make yourself worse off in terms of a property deposit. So there's a lot going on here when we talk about investing, and it isn't a straightforward and simple thing. It's very nuanced.
for me, let's say, for example, my own journey, right? I started investing in about like 2016 in Vanguard. And after like reading a few books and after kind of realizing S&P 500 or like watching like YouTube with investing in etc. So that's kind of how I started. And then the pot grew more and more. It's, as you said, keeping it simple and putting money every month to an account and let it, as you say, long term to invest it. If like someone was like 18 years old and he could put aside £100 a month, by the time that he would want to probably buy his first property, 28 to 30, that money will have doubled. It would have been in his account for 10 years.
Exactly. It's a snowball effect compounding, isn't it? You start with a little bit and then it grows, you get the bit of growth, you reinvest the growth, and then the growth on top of the growth that you've already captured continues and continues. So yeah, start early if you can. If you've got the means to, the sooner the
Yeah,
start, the better off you will be. Is just what data shows over however
yeah,
many years the data goes back. It's yeah, if you can start, certainly make a start. But if you've not started already and you have the means to do so, well, why aren't you
yeah.
considering it?
Which brings me to the next question as well. So, what would you say is the best way for a young person to start investing? We have like passive investing or active investing, and then also like single shares that you can buy because they think like maybe like Nvidia, as you have seen recently, or we have like ETFs in Vanguard, or mutual funds, and etc. What would be your recommendation?
Yeah, I guess how I would approach this question is probably maybe a little bit of a non-committal answer, if you like, because
Okay.
again, it depends on the individual circumstances. But I
Yeah.
wouldn't even start with the investment strategy. First of all, you again set your goals, what are your time horizons, but really I would probably look at the two products and say, well, actually, do you want to lock your money up for a very, very long time or not? So I would start with, well, actually, should we be looking at stocks and shares ISA or
Hmm.
a pension in the UK? So they're both very tax efficient and work slightly differently. So I'll start with information about pensions and ISAs, and then we can maybe get onto the investment strategy, because it's all well and good saying, well, invest in the S&P 500 or an ETF or anything you've just listed there, but actually, well, which product should you go into and open the account with to access that investment? So ISA's dead simple. You can put in up to £20,000 a year into them, tax free from the point of income tax and capital gains tax, and there's no restrictions as to when you can access your money. They're probably the easiest one to understand.
Okay. Yeah.
Pensions, slightly different. You put your money in, you get a little bit of tax relief in. So for every £80 you put in, generally you get £20 on top straight away. So it's a nice boost. The trade off being you can't access it until the normal pension age. So if you're
Yeah.
18 to 25 and you're thinking, well, actually, I might need this money a little bit sooner than that, I'd probably go for an ISA. But again, both are extremely tax efficient. The normal pension age, to put in some context, is currently 55. It's a way to
Yeah.
rise to 57 by 2028. Will it rise again? Will we get a pension? Hopefully,
Probably.
hopefully we'll get a pension.
I don't know.
I
Yeah.
would assume the pension age, the normal pension age, will change before we
Yeah.
come to access it, just with obviously different government policies and whatnot. Obviously, most people will have a pension through their work, and I would say take advantage of it. But in particular, just thinking about, well, actually, if we're framing this towards 18 to 25-year-old, there's a standard stocks and shares ISA, but another interesting one is the lifetime ISA. So you can pay in £4,000 each tax year into that and get a 25% bonus. So think about it. If you can pay £4,000 in, a grand bonus from the government to go to your first property purchase or retirement, you should take advantage of that. It doesn't have to be
Yeah.
invested, it can be cash, a cash lifetime ISA as well. But those are the two starting points. I would say sit down, think about your goals. The chances are you're probably going to have both running in tandem, so you might have your workplace pension, and if you've got spare cash, well, you could go more money into an ISA, or equally, if your employer is very generous, they might do a thing called matching contributions. I don't know if you know too much about
Yeah.
that. Yeah, so it's a great way. If you pay in additional contributions, the company might match them. It's essentially money for nothing, so you'd be daft not to take it. But again, it depends on what you want to get out of it with your goals.
Yeah.
Underlying investments, you can pretty much access the exact same investments within an ISA and a pension, to be honest with you. So again, you alluded to active and passive, two completely different ways of going about it. You hinted that you went
Yeah.
Vanguard. Do you want to explain a little bit why you went for Vanguard and your rationale, and then I'll maybe say what we favour, just to keep
Yeah.
it interesting.
Sure. I think Vanguard was the only one that I know. So my mom is American, right? So she knew about Vanguard and she told me about Vanguard. And I think back in the day, it was the easiest option to do.
Hmm.
You know what I mean? Like I was like, I knew Vanguard, the biggest ETF kind of like provider in the world, and I was like, okay, cool. Low cost um, ETFs and like charges, and I was like, okay, I'm gonna just put it there, and that's how I started.
Good. It's a good place to start.
Yeah, 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 yeah. To be honest, it's quite interesting what you said with the ISA, because, like, for example, that was the mistake I did the first time. So when I opened my Vanguard, I opened the general account, and that is, as you say, like, it's no tax free. And then I had invested, like, maybe I don't know, I can't remember the amount, but then I had to reopen or transfer it into an ISA, and that is kind of like one. But like knowing from the beginning, okay, cool, let me open an ISA in whatever platform and put my money through my ISA stocks and shares. Just makes it easier, I guess, and more convenient.
Yeah, I mean, yeah, the general investment account, they were fine for a long time, but the governments have cut down the tax rates. So it used to be quite favourable. Your capital gains tax allowance used to be 12,300, then it was 6,000 this year. This new tax year is 3,000. So if
Yeah,
you can get most of your money in an ISA before using the general investment account, great.
makes sense.
If you're in a fortunate position to have enough money that you can maximise your ISA and then put some money in a different account, you might have to pay some tax depending on which route you go down. But typically, what most people do is just try and get everything into their ISAs, into the pensions, just to ensure
Yeah,
tax efficiency.
and
Oh,
I
sure.
think with the ISA, it's £20,000 per year, right?
£20,000, yeah, across the different types of ISAs. So obviously, I've mentioned the stocks and shares ISA, the
Yeah.
lifetime ISA. There's cash ISAs as well, but you can spread your money across those different products. But the
Mm-hmm.
limit across the full year is £20,000. And the key thing is,
Yeah.
it's a use it or lose it. So say you only put in £10,000, you can't carry forward any unused allowance. Now, I know we're specifically talking about 18 to 25-year-olds. I don't know
Yeah.
any 18 to 25-year-olds that will have that money
I
lying
know. I
aside.
know.
But if
Yeah,
they do,
exactly.
or they have generous parents who might gift them, or they have an inheritance, yeah, they certainly
Yeah.
get as much money into an ISA as possible, I would say.
Yeah, I think like to reach the point that you would be able to exceed £20,000 a year to put into your ISA, we're talking about like maybe 35 to 40 years old, or like entrepreneurs,
Oh,
business
you'd
owners,
have to be
like
doing great to be able to afford it. It's only
yeah,
very
yeah.
few people that can do that. It's a nice thought, though.
Yeah, of course, no, 100%. You said about like splitting your money into the different ISAs, right? The different products that we have. So regarding like diversification as well, how do you effectively diversify your portfolio while limiting risk? Do you think like diversification is important? And how would you go about that?
Yeah, it's very important. Typically, yeah, it's as easy as the phrase says, don't put all your eggs in the one basket, and it's really just about spreading your money across
Mhm.
different areas of investment. So whether that's different asset classes or different countries, different sectors, the more spread out, the less risk there is, if you like. So there's different risks when it comes to investment. So for the purpose of this, we'll just call risk volatility. We just
Mhm.
keep it simple. So
Yeah.
if we can say, well, actually, using a passive investment strategy, we'll give you exposure to the thousands upon thousands of the greatest companies in the world across the globe. It takes out company specific risk. But again, just because we're eliminating that doesn't mean there are no risks. It would be great if there was. There's things like market risk, which you can't account for, so war, inflation. But certainly, we believe in spreading things as wide as you can. So that's why typically at Executive Wealth Services, we favour kind of lower cost passive instruments. So typically a portfolio could have up to 20,000 underlying holdings. Can you get more diverse than that?
Yeah.
Probably not.
Of course.
So that's where we go, and I guess as well, clients want that peace of mind. Yes, they want to have some level of risk to get the reward, but most clients won't want to go to bed at night worrying about, well, actually the significant fluctuations. And don't get me wrong, passive strategies, you're going to see significant fluctuations, whether it's active or passive, but it's about managing that volatility. So any financial advisor that you speak to will say they'll probably do a risk profile questionnaire that'll lead to more in-depth questions about your understanding and tolerance and appetite for risk, and then they will build the portfolio for there. Different again when you're younger, you've got a little bit of time. Time is on your side, so typically you should be going for the kind of higher equity investments. So although we've talked about diversification across asset classes, if you're 18 to 25, you're paying into a pension, you've got decades till retirement, you actually want to take more risk because you can't touch it. It doesn't matter if it's going up or down. In the short term, you're playing the very, very long game in that sense. So that's why we favour kind of the lower cost passive strategies, just because they are so diverse.
Yeah. 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 And you can easily do that. Yeah. No.
It's
Yeah.
it's
I
easy
do
to
agree
do
with
as well. So I mean, if you're a
you.
new investor, look, I'll always, as a financial advisor, I will always advocate for people seeing financial advisors because it just helps make good financial decisions for you. Even if you go and
Yeah.
have a chat, most advisors will have a free chat with you over a coffee and see, well, actually, can or can't we help you? However, in this day and age, information is at the touch of your fingers, isn't it? It's on your phone. You
Yes.
can Google it. There's YouTube videos. There's whatever there. So a lot of people like to do the DIY approach.
Mhm.
I'm not saying that's wrong. If you've got simple needs and you're confident, by all means crack on. There are useful guides out there. So for example, you could go into like a Vanguard life strategy fund or whatnot, It's ready made for you. You go on the website, it says, well, how long are you investing for? What's your risk appetite? Here's a fund for you. It's taken care of. So people can do that, and those types of funds and ETFs are very well diversified.
Yeah. No, I do agree. And I think for providers like Vanguard, BlackRock, and etc., they offer such a massive variety of ETFs. Let's go with ETFs. And you can pick every market. You can have like Europe, you can have US, you can have Asia, wherever you want, and you'll find an ETF. And then like not even by country, but then also by industry that you want potentially to invest.
Yeah, it's amazing the opportunities that are out there in terms of what you can and can't invest in. It's you can pretty much invest in anything through ETFs or even simple collective funds where your money's pooled with other investors. It's super diverse. It takes all of the sort of investment decisions really away from you. So yeah, I would say if you're looking to do a DIY route, if you think, yep, I'll give it a crack, or you've only got a small amount of money and you think, oh, actually, I'll just have a little bit of a play about, if you like. Again, I wouldn't say play about, it's a big decision, it's for your future. But things like Vanguard Life Strategies, you can't go too far wrong with them as a starting point. Another platform that people use, AJ Bell, they'll have a cautious fund, a balanced fund, a growth fund, those types of thing. Again, you put your money in, all the investment decisions are made for you, and you just let it run. The key is patience and not expecting things to happen overnight, which is a big downfall for not just young people, actually. It's people in the modern world. It's the instant gratification. People need to be patient and disciplined, and they'll reap the rewards over the long term. It's a difficult thing. Nobody wants to wait however many years to see it.
True. But it's a very good answer because like you're bringing me to the next question as well that I have. You get a lot of like get rich quick schemes, right? So you have like cryptocurrency, you have like pyramid schemes, you have a lot of YouTubers. I think a lot of influencers, Instagram, YouTube, they say, "Hey, buy my product and like, I will make you rich." And that's the issue with a lot of information that like it's there available, but you don't know if you can trust it. From your perspective, what do you think of the get rich quick schemes and etc. Yeah, to become rich and etc.
Yeah, there's definitely a rise in get rich quick schemes. We see it. Obviously, I see it online, Instagram. I mean, they're everywhere. There's targeted ads will pop up for it, but we're even seeing clients coming in asking about them, or prospective clients coming in and asking about them. I mean, the general rule of thumb is if it's too good to be true, it probably is too good to be true, and it won't happen. I mean, there's different types of get rich quick schemes, which you kind of alluded to there. The multi-level market and pyramid thing. Don't get me wrong, the people at the very top probably making a lot of money from it, but they're also using their friends and family and saying, I'm going to make money off you, buy this product. They buy the product, might not be able to sell it. So they might. I don't really believe in it, but it's the very, very few that make it. And it's the same for cryptocurrency. What are my thoughts on cryptocurrency? I guess you could ask, well, are people making money from it? Clearly, yes. Is there a reason to be making money from it? I'm not quite sure because it doesn't tend to be backed by anything. So traditional investing, so like we were speaking about stocks and shares, you're essentially buying little bits of the greatest companies in the world. So your Amazons, Apples, Alphabet, Nvidia, those types of companies. With cryptocurrency, it's very much driven by like supply and demand and hype and what people are thinking. So will that always continue? I don't know. I didn't think it was going to do as well as it had the sort of last year or so. It just goes to show you it's clearly know nothing when it comes to that. But don't get me wrong, there's opportunities out there in cryptocurrency for people. But again, I think it's pure luck, as very few people make the money on it. So I would say if you do have money to invest, go for traditional investments that are backed by something. Don't just put it all in cryptocurrency because you see 100 times returns over such a quick period of time, because that is just absolutely not normal. It's just not normal. But because you see it online and you see, well, your favorite influencer's made X amount because it's returned 100% or whatnot over a space of a few months, it's just not normal. And to be honest, I think people should be very, very, very cautious when it comes to cryptocurrencies. Another thing we're seeing the sort of rise of is day trading. Just absolutely bonkers that people like you or I think they can look at charts and candlesticks and try and guess a trend. It's not how it works. It's just not how it works. So I'm sure the stat for that is around 90% of people who try and day trade lose money. So I guess that's a roundabout way of saying get rich quick schemes. Is there such a thing? No. Should people
Yeah,
get involved in them? No.
yeah, yeah. No, I agree. And it's unfortunate, I think, because, like, for example, you do have a lot of people who do, again, you're like 18 to 25 and you're thinking to yourself, oh man, like I'm gonna work for another 40 years, the traditional 9 to 5 and etc. And I don't think that should be the case. And kind of like, what I told you also, like in person, like that's the idea of the podcast, that you don't need to work like 9 to 5 for 40 years. But like if you think that you can start at 18 to 25, start investing your money, by the time you're like 35, 40, and if you have a plan and goal, you can make a big progress. And if you get into the property ladder as well, you can have like one or two, let's say rentals, or like you can live in one, rent another property. Then you will be in a very good position to not have to work or not be stressed for money, which I think like people nowadays have a lot of stress when it comes to money, right?
Yeah, I mean, well, the cost of living is dramatically increased, even just over the short term recently we've seen. So
Yeah,
you're right, it comes back to that thing, starting early. I mean, I've just reviewed or spoken to a prospective client there, and he's mid 40s and he's got over £700,000 in a pension just because he started when he was 18 and was disciplined and kept putting it in and kept putting it in and didn't go out and buy a fancy car, a new
yeah,
pair of shoes every week. It's people who do well for themselves. They're savvy. They're savvy. They can stick to it. But yeah, the sooner you start saving for your future, the better.
the better. Yeah, it's crazy. Yeah, I have a very good friend of mine as well, and he is like, meticulous. Every month he will put X amount of money into his investments, and he has like a Google, an Excel chart, and he says, "Yeah, by the time I'm 45, I will be a millionaire." Like for me, that's crazy. Like, he knows because, like, 7% per year, by the amount of money he puts every month, by the age of 45, he's now 26. He will be a millionaire, and it's like,
Yeah,
it's so, yeah,
it's
it's
amazing.
ridiculous.
It's unfortunately it's not something that you're taught at school. You don't really get good financial education. I mean,
Yeah,
I'd fully admit that before I started working in financial services, I had no clue. I had no clue.
yeah,
And then people just wander through life thinking, well, okay, we'll save money for a holiday, we'll spend it on the holiday, so on and so forth. Nothing wrong with that. They'll buy the new television, they'll get a bigger house, they'll do whatever, but they don't think about the things we are discussing, savings and investments. So when they come to retirement, yep, they'll have had a great life up until that point, and then it's okay. Can I retire at 60? Well, actually, Mr. Client, you don't have enough to be able to afford to, so you'll just need to work on a few years, and then they think, oh, hang on, I should have started a lot younger.
yeah, 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 yeah. No, that's the biggest one. I agree with you. And I don't know, like sometimes, like, this is maybe a weird example, but like I have gone to the supermarket and you see like an old person working, right? Like, maybe like a 65, 70 years old. And like one, it could be like a part-time job that they have because they want to be social. On the other hand, it's like, oh, it could be that. But you said, like, they don't have enough money because they did not, unfortunately, they did not learn about finances and etc. So now they have to keep working because they don't have enough to retire.
Yeah, no, you're right. I
Yeah.
mean, for me as a financial advisor, the hope is that all my clients can meet their goals. It's not always the case. People, unfortunately, we do have to have difficult conversations and say, well,
Mm.
actually, you're probably going to have to work on. So that's why if you can start young and think about that long term goal, it's the best way to go about it, isn't it? And I certainly don't want to be working well into my 60s. Hopefully not. Hopefully not.
Yeah.
But you never know. Nothing's guaranteed in this life. You can only try and carry out the plan and stick to the plan, and that's the best way to try and get there.
Yeah, no, I agree. So let's say, okay, like a summary on this is what I know that you probably will say it depends, but like, what would you say are the 5 goals for a young person when it comes to personal finance? What they should the 5 steps, you know what I mean?
Five like
Yeah.
sort of tips, if you like, or what they.
Yeah, 5 tips, yeah.
Yeah, okay. I guess start saving and start saving early, even if it's a little bit of money that you've got every month. As we mentioned,
Yep.
compounding, it's so powerful. It'll stand you in good stead. Time's on your side. And again, when it comes to starting early, don't be afraid to take a little bit of risk with investing. I'm not saying obviously to chuck it all in crypto, put it in traditional investments through a stocks and shares ISA. Even speak to a financial advisor, and they'll have a chat with you and say, well, actually, what should I do? If they don't meet the sort of minimum investment that some might have, they'll give guidance anyway. We're all here at the end of the day to help people. It's not purely about making money, it's about helping people. So that is the first thing. Start, even if it's to start investing or saving, even if it's a small amount.
Mm-hmm.
Sit down and set goals. So they need to be specific and measurable. Otherwise, it's more difficult to work towards. For example, if you're looking to buy your first property, you think, well, okay, I might want to buy a property at £150,000 for the sake of round numbers. Well, what deposit might you need? Work backward and say, well, I need a deposit of £50,000. Okay, how much should I put away each month, and how long, and when do I want to buy? Those sorts of questions that you ask yourself will help you get there quicker, and it's easy to keep track of, well, actually, I'm on track or not. Because if you say, well, I want a deposit, but I don't know how much, how do you know when you get there? You don't. So that would be the second thing. Really sit down and have a think about what's important to you and what you want to get out of your money. The third thing I would say, probably build an emergency fund. So life, it's all well and good investing. You
Yes.
don't know what's around the corner, so you need to have some cash sitting aside. You don't want to have too much cash, obviously, because as we spoke about, inflation will erode the buying power of that money. But
Mm-hmm.
every good financial plan, you should have a bit of money set aside. So typically you would look to have around 3 to 6 months worth of your outgoing set aside. That's just a general rule of thumb. It might be different depending on your own circumstances, but it just gives you a little bit of peace of mind. So if things don't go quite well with your investments, you know you're going to be okay. And it's not even just with your investments. You could be working and lose your job. Well, you know you're going to be okay for a few months. You've got that time, the stopgap, if you like, until you get a new job. So that's pretty important. I think could be often overlooked. You see a lot of people just putting all their money in investments. Not the right thing to do. An emergency fund is important. What else would I do if I was 18 to 25? Budget planning.
Yeah. No, I could
Admittedly,
agree.
something I
Yeah.
did not do when I
Yeah.
was 18 to 25, but keep a track of what your income is and what you're spending, whether you do it on an Excel spreadsheet, or I know some of the banking apps. So, for example, Monzo's quite good for that. Just make sure that you know what's coming in and going out. I mean, that sort of bit of hint and tip has been around for, gosh, forever, I would imagine. It just lets
Yeah.
you know that you're not overcommitting, you're not spending money that you don't have. And
Mm-hmm.
finally, what would my last one be? Probably just paying a pension. Paying a pension, because if you think about it, like I say, time's on your side. You can go 100% equity, take the most risk, go for the growth. But equally, if you look at it, the pension landscape's changed. So pensions used to be very attractive, and back in the day, they were called final salary schemes. They provided a guaranteed income for life in retirement. We don't have that luxury anymore. What we get out of retirement is very much depends on, well, actually, how much do we invest? What does the investment return in terms of growth? Then that determines how good a retirement we can have. But again, it comes down to, well, the sooner you start, the more you have in your pot, the earlier you can retire. And life is to be enjoyed.
Yeah.
I don't think it's to be lived and worked until you drop. I think you need to create these good habits, build a pot, retire early, and enjoy yourself, because what's life if it's not for living?
Yeah. No, I do agree. No, that's a good point as well. When you said about the emergency funding, I realized that from personal experience. I lived in Greece for 3 months, and then I came back here. But before that, I went for a trip. And like I went to Vienna for 5 days. So I spent like my savings over there. Then I did not realize how, like for example, coming here, I needed to find a flat. So then I had I needed to give like another like almost £3,000 on the first month's deposit plus the rent. So by the end of it, I realized that like why did I go to Vienna for a trip? Because now I'm like I don't have any money. Because like for example, like that emergency fund can be so important, and like not a lot of people have like an emergency fund, but it's so important because like it just something can go wrong so fast and you just, if you don't have the money, then you're screwed. But if you have the money, then you're like, oh, I'm happy that, like, I was thinking into the future and have now, 3 months, 6 months of emergency money
Yeah,
I can use.
exactly. It comes back to the whole peace of mind, and that's what people want when they look for financial advice. It's peace of mind. Are they going to be okay meeting their goals, whether that's putting their kids through school, retirement planning? The question is, am I really going to be okay? So that emergency fund does give you that peace of mind, and that it buys you that time. It means you don't have to maybe necessarily go into the overdraft or put money on a credit card. The money's there. Yes, you've built up that money. You probably don't want to spend it because everyone gets attached. You work hard to save that money, but it's there
Yeah.
for a purpose. Anything you do, whether it's an emergency fund or an investment, it serves a purpose. You can always rebuild it back up. It might be difficult to do so, but yeah, certainly anyone who's not got an emergency fund out there and is listening to this podcast, please try and build one up.
Yeah. Like, I learned my lesson, and, like, 28 years old now, and I learned that. So let's move on to debt. Okay. So what do you think of, like, credit cards, and should young people have credit cards?
Yeah, credit cards is a funny one. I think there's everybody kind of, especially if you don't have a credit card or you're not very financially literate, it can be quite scary. You hear the horror
Mhm.
stories. So I would say it depends on the person. Not everybody necessarily needs a credit card. Obviously, if you get a credit card, you can build up a credit score by paying it back at the end of each month. That means that you can maybe borrow more. So if you go for a mortgage or a loan, your credit card, your credit score will affect that. Should everyone have them? Only if you're going to be sensible about it. I think most, I like to think that most people are sensible when it comes to credit cards. Most young people aren't actually daft, although they do get a bad rep.
Yeah.
But it's important to understand that it's not free money. You have to give it back. Just because you might get a credit card and they say, okay, your limit is probably going to be quite low if you're 18 years old, and maybe it's £1,000 or whatnot. You're still going
Yeah.
to have to pay that £1,000 back,
Yeah.
plus interest potentially if you miss the
Yeah.
payment. So you need to be aware of that and understand it, but it's not really anything to be scared of, because if you're
Mm.
disciplined and okay, well, I bought this thing, or what I used to do actually when I was 18, I would buy my petrol with it and then
Okay.
just pay it off, or I'd buy my food shopping with it and just pay it off. Just
Yeah.
just little things. I wouldn't take it on nights out or anything like that because then
Yeah. Yeah.
you might have a bad time. But as long as
Yeah.
you're sensible with it and can exercise self-control, then there's no harm in it. Different credit cards as well. I mean, they serve different purposes, don't they? So some of them are better for travel perks or getting air miles. Some of them might have 0% interest. So um, they can be good and they can be bad, just like anything else. Credit cards, I would say, can be quite useful for large purchases because there's
Mhm.
more consumer protection when you use them, because it's not actually your money, it's the bank's money at the end of the day. So yeah, are they good? Are they bad? It depends. It
Yeah.
depends what you use it for.
Yeah.
Certainly, if you get one, just be very, very sensible with it.
Yeah.
Otherwise, it can spiral. And I have dealt with people and spoken to people who have had quite considerable credit card debts. And let me tell you, it puts a lot of stress on them. And nobody wants stress in their life. So
Yeah.
just be sensible.
Yeah. On that, right, like, with those clients that they have the debt. So basically, like, for example, what I want to say now is that, like, for the 18 to 25 who have taken the debt, right, and he has, like, maybe a few or three credit cards, max them out £1,000 each, let's say, so they have like 3, 4 thousand pounds in debt. What would you recommend? Like, is there a strategy? Like, do you pay your debt off first and then invest, or what would you recommend for someone who has already debt?
A general rule of thumb, I would say clear your credit card debt prior to
Hmm.
investing. Again, obviously, it depends on the specific circumstances and the rates involved and whatnot. And what people used to do, or sometimes used to do, is when the interest rates on loans or credit cards was low, you might get a better rate from like a fixed interest savings account or whatnot, so you were guaranteed that return. Things have changed as interest rates have gone up recently, quite considerably. So I would say if you've got money on a credit card in terms of debt, try and clear that first before you think about investing. Obviously, we're saying investing is a long-term game. Um,
Yeah.
Paying back your credit card shouldn't be a long-term game. You should be doing it every month, first of all. And when it comes to the returns that an investment can generate, nothing's guaranteed. It might work in your favor, it might not, but the short time frame that we're looking for, yeah, I would say go for the clearing of the credit card. Use that as a line in the sand. You're at a good financial place, you're steady, then go forward and think about other investments.
Yeah. What are some of the mistakes you have seen like through your career? Like you kind of gave an example that you had clients with high debt, right? But like, what are some of the mistakes that common mistakes that people do when it comes to debt?
Yeah, I guess thankfully I've not seen too many people
Okay.
struggling with debt. Mainly, it's people who don't repay their credit cards in full, or they default on debt and get bad debt, which can really affect their credit rating. But not really a mistake, I would say. But an important one is seeking help and not feeling embarrassed to do so. I spoke to somebody just a couple of months ago who had quite a significant amount of debt, and they let it build and build and build, and it was more to do with they felt embarrassed about opening up and saying, actually, I need help, I need assistance, I need guidance, and it
Yeah.
makes things worse. It's nothing to be embarrassed of or ashamed of. I mean, anything can happen to anyone. It just takes one thing going wrong in your life or something not quite going your way, and it can spiral. So I would say that's probably another thing. Just be open to seeking help. There's debt charities out there that will help you. Financial advisors can potentially help you or guide you the citizens' advice. But even letting your bank know if you're not going to be able to make your repayments, they can sometimes assist with sort of like payment plans and whatnot. Hopefully, it doesn't get to that point. But yeah, just if you do find yourself in that scenario, know that help is out there and don't be afraid to talk about it. Nobody's going to judge you for it. And I think that's probably the most important thing that I've realised about debt. It's not so much well, I've made this mistake. Actually, it's owning up to the mistake, if you like.
Mm.
It's nobody likes to admit there are mistakes, and people in the UK are very proud and don't seek help.
Yeah.
If you find yourself in that, I do encourage you to reach out to somebody.
Yeah. No, it's interesting. Yeah, and then also, like, for example, like with the, online like banks like Monzo, Revolut, and etc. From what I have seen, is like it's quite easy to get like a loan, right? As well. I have done that. I have to say, I will be honest with you. I have done a mistake, and I had taken a loan from Monzo that now I'm paying off properly. But yeah, it was a financial mistake, and I was like, yeah, that was a massive mistake, and I'm still paying for it like 2 years later. But yeah, if it happens.
Life is full of mistakes. How do
Yeah,
you hopefully learn from your mistakes and don't make that mistake again? I mean,
yeah,
thankfully, there used to be like the payday loan type companies, which were really particularly bad for that. There's not so many of them going around now, but if you're ever looking for a payday loan, I'd certainly try and avoid them because that can spiral very, very quickly. But yeah, I guess it just comes down to be sensible. If you're taking out a loan for something that you don't really need,
yeah,
don't do it. Just
yeah,
don't do it. If you're taking out a big loan to buy something daft or go on a holiday that you don't really need and you can save up over another few months and maybe go next year, think about that first.
yeah. Let's go to the last kind of like section, which is like financial literacy, which I think is probably the most important thing, right? What are some financial habits or principles young people should adopt to set themselves for long-term financial success?
Okay, very simply, be consistent.
Yeah,
If you've got spare money each month and you can pay it in monthly, do that. Be consistent with it. Don't start it and stop it. Just create that habit. Set up a direct debit. Forget about it. Obviously, you can, if you needed to, you can stop that direct debit if you needed the money. Try and be consistent and disciplined. But patience. Again, it comes back to patience. Nothing happens overnight, and don't be afraid to take some level of risk. If you are really worried about things, again, come speak to a financial advisor. We'll be happy to discuss risk with you, and hopefully put your mind at ease, because without taking the risk, you're not going to get the reward at the end of the day. So I would say those are probably the main things. But also everything in moderation, isn't it? Like, yeah,
mm,
you might have a bit of money set aside, or you've got excess income each month. I'm not saying put absolutely everything in investing. It's about balance and moderation, just like anything in life, whether that's alcohol or exercise. You don't want to go 100% into it. It needs to it needs to be at an appropriate level.
Yeah. No, I do agree. And especially like what you said about like speaking to a financial advisor, because I know someone who has like almost like 20,000 pounds in the bank with 1% interest. And even though I have told them that like, hey, like, you should start investing or like look into it, because like even though you think that you put money every month, but it's 1%. So every year you are actually losing money in reality.
Yeah, it's sometimes very difficult to convince people to put the money from the bank into an asset which can obviously move up and down. Sometimes you can't reason with them.
Yeah.
We have the same situation. We'll have people coming in, they're sitting on however much money, thousands of pounds, hundreds of thousands of pounds. Oh, Mr. and Mrs. Client, you should invest this. It'll create a better retirement for you, and any money left can be passed on to your children. Oh, but we don't want to see it moving up and down. There's only so much you can try and persuade people. It's not for everyone. Yeah, I'm
Yeah.
sure your
No,
friend is much the same. They might come round eventually.
yeah.
But yeah, if they're getting that lower rate, yeah, luckily you know yourself the power of investing and the downsides of inflation. So hopefully you'll be putting yourself in, standing yourself in good stead.
Yeah, yeah, no, it's unfortunate that you can't help everyone. You can help yourself and, make your plans for set your goals and etc. But like you can't help everyone else
Mm.
or like nobody else to be honest apart of yourself. Yeah.
Yeah, exactly.
So for young people who want to educate themselves in money, and personal finance, do you have any books or podcasts that you would recommend?
I'm not so much into books or podcasts, to be honest with you. A lot of my self learning is done just through Google searches and YouTube and whatnot. So if I was going in with no prior knowledge and I thought, okay, well, I want to know a little bit about investing, maybe you listen to this podcast and you think, well, actually, active or passive investing, diversification, risk, and a really good free resource that you can look at is different investment companies. So I know we've mentioned Vanguard and AJ Bell, but there's Hargreaves Lansdown, those types of companies there. If you just Google them and say, for example, Vanguard investing or retail investor, that type of thing, it'll take you to a bunch of different guides saying, okay, what is investing? What are the benefits of investing? What are the risks? What should you consider? What you should you think about before investing? And also, there's a government website, Money Helper, which breaks it down very, very simply into layman's terms. So those are good starting points for articles. I mean, if you Google anything, you'll pull up
Yeah.
millions of resources. Another one that I quite like is YouTube. Just because they can obviously, the creators can bring up graphs and charts and diagrams, and I find visual learning a little bit easier than just listening. What I would say is make sure that whoever you're listening to is actually a qualified financial advisor. There's probably not very many of them. Most of them will be sort of like your financial influencers. But one chap, I don't actually know the guy, but I've seen his videos. Is a guy down in England called James Shack. His YouTube channel is called. He's actually a qualified financial advisor, so he's well worth checking out. I guess once you're on there, you'll lead you down the algorithm and you can take it from there. But yeah, I would certainly say just whatever you're doing, make sure it's from a real investment company or a real financial advisor, because otherwise these influencers are mainly just trying to sell you on a course or get you to use their referral code, and it might not have your best interests at heart.
Yeah. No, I do agree. I do agree. And that's like the case as well. Like I do want to reach out to experts like yourself to get the advice. I don't want to speak to whoever has an Instagram account and has like 100,000 followers, whatever, and they speak about finance because, like, yeah, sure, like they might have the same knowledge, but at the end of the day, if they're not a professional, then why are you getting an advice from them? I don't know. Yeah,
Yeah, it's amazing how many people are out there trying to give advice when they shouldn't be giving advice. But what can you
yeah,
what can you do if people have access to an internet connection? You can pretty much post whatever you want within reason.
yeah, yeah, yeah. Yeah. Question for you: if you could go back to time, what advice would you give to your younger self? Let's say 18.
Okay, if I could go back to when I was
Yeah,
18, I mean I was a fairly silly young 18-year-old just going to uni at that point. probably
Yeah.
partying too much. I would say be more disciplined, and not
Yeah.
just in terms of finance, but in terms of studying, in terms of exercise. Be more disciplined. It creates the good habits,
Yeah.
and it sets you up for a more successful future. Particularly, looking back at how I was, I certainly was not disciplined at,
Uh-huh.
at all. So I would say if you can be, it's difficult to do. There's a lot of distractions out there. If you are on Instagram or social media, the easy thing to do if you're bored is pick up your phone and scroll. Be disciplined is what I would go back and hopefully change if I could anyway.
Yeah. When you're at the moment, you cannot realize it. You can only, when you can see it in the past, that's when you realize, oh, yeah, I should have done that because it makes sense.
Yeah, definitely. What would you do for yourself?
For myself, oh, that's a good one. Probably commit to invest. So basically, for example, when I started investing in Vanguard, I would pull out the money and just put it back in. So basically, for example, again on holidays. So for example, I would take some money out because I wanted to go on holiday, and then like I did not see the full potential of the money growing over the years. And then I would put some money, but then let's say, for example, I would pull out £1,000, and then over a month, or over a year, sorry, I would put £100. So then it would take another year to go into the thousands, to the £1,000 that I took out. So that was a trick one. So yeah, like just commit, as you say, like commit to it, direct debit, put your money away, and just don't look at that money. Do not touch it. Do not think that they are yours. It's just for your future self. That kind of like if you can have that mentality.
Yeah, it's an interesting one, not quite the same, but another, just thinking back to the mistakes that people make,
Mhm.
particularly one thing we see, you mentioned taking money in and out for holidays or whatever
Yeah.
you might want to spend it on. If your investment takes a dip, people often panic and say, well, actually, now is the time to cash out. A lot of my job is, well, it's actually holding clients' hands and walking them back from the edge of the cliff of making poor financial decisions. I mean, an easy example, you'd look at COVID, everything
Hmm.
absolutely dropped, didn't it? I'd imagine all the clients who had investments, most of them, if they were DIY investors and didn't have the reassurance of financial advisors, would have been quite panicked. They might think, well, actually, things have dropped 30%, let's take it out. It's the worst thing to do. Really, in times of crisis, often the best thing to do is do nothing and just let it ride
Yeah.
out. So again, that comes similar to what we've just discussed, is commitment and discipline. You're looking
Yeah.
long term, that recovered and then some in the space of a year. So if you were committed and disciplined and looking at the long term view, you would have made money off it.
Is there like clients that you have that have been very good at investing, and you kind of like makes you realize if they're like business owners and etc. and say, okay, that's why they're successful because they have that discipline, they have that commitment, and you can see their pot is growing. They're being successful financially.
Yeah, I mean, it's a very difficult one because we see such a broad
Yeah.
spectrum of people, and then you could say, well, actually, what is success and who is successful? If you're talking about the largest pot size we see, it's people who start early, stay
Hmm.
committed and trust the process, um, and also people being aware that maybe financial advice or investing isn't their area of expertise, and they're happy to just delegate it to professionals to create a better outcome. I mean, there's a statistic out there that says if you use a financial advisor, you're likely to be around £47,000 better off at retirement. So it just goes to show the value of using professional advice. But yeah, in terms of traits, and it really just does come down to giving yourself enough time to invest and sticking with it. There's no point in being half in, half out and trying to change things. We as a business are very much long term buy and hold. We use passive strategies for that. We don't swap client portfolios for the sake of it. And equally, when you say sort of being successful or good at investing, I mean, what does that mean? A lot of people will try and go for active management to try and get great returns. Why don't we just cast like a wide net, go for the passive, well diversified, and get average returns? Because actually, average returns are still very good returns.
Yeah.
So that's what I would say. Different between different clients. If you're talking about people who are successful in business, that's probably a different conversation. They're very driven and determined, willing to make sacrifice. not everybody is willing to make sacrifice. But I mean, you look at the top business leaders, or even people who do well in their own business, they give up a lot to get there. Being a small business owner, whether it's you're a big business owner, a little business owner, it's a lot. If you're self-employed, you are giving up a lot. They'll be seeing their kids less, which they probably regret, I'm sure, at some point. But it is that pure drive and determination to stick at it when things might not be in their favor, and being able to take the risk and yeah, just going for it.
Yeah.
Having confidence in themselves, I would say, actually.
Yeah. No, I do agree. I do agree with you on that. I was just gonna make it personal to me, but like for example, like that's what I realized that like in order to make anything, you do need to put yourself out there to get out of your comfort zone.
Yeah.
And I think business people, successful people, do sacrifice that, or like they go out of their way, out of their comfort zone to make it happen, and hopefully, majority of the time they're rewarded for getting out of their comfort zone.
Well, it's like,
Yeah.
yeah, I mean, it's exactly like what you're doing. You didn't have to start a podcast,
Yeah.
but you've decided to
Yeah.
start it. It's that old thing, the man in the arena, isn't it? You've got to put
Yeah.
yourself out there. People can laugh at you or throw stones, but they've never given it a go. So
Yeah. Yeah.
it's the people who are the doers that will probably have the more successful life. If you think about it, there's people who do things and people who don't, and it's the doers that will get there.
Yeah. Interesting. Two more questions, and then we can wrap it up as well. If someone, this is a completely different question from what we have talked, but like if someone is inspired, by what you do, what are the steps like someone can follow to become a financial advisor?
Yeah. So I mean, like I said at the beginning, I kind of fell into it. I didn't really know too much about it as a career. If you are interested in it, I would say look for job openings for financial services, admin roles, or paraplanners or trainee paraplanner roles. Apply to these businesses, reach out by email, ask to have a chat and say, well, actually, what's it all about? You might think, well, actually, I'm inspired by this conversation or another conversation that they might have heard. But until you actually sit down and do the job, it might be completely different to what you think. It's not easy being a financial advisor. It's a difficult role because yes, you're helping people manage the money, but you're also managing people, which isn't always easy. It's a great job. It's a great career. Don't get me wrong. I'm lucky and privileged to be able to do what I do, but I'm early days at it. Hopefully, I continue to feel that way. But I would say, yeah, look for these different types of jobs. Look at the job requirements on the application forms, that type of thing, and see, well, actually, how do your skills marry up? What else could you be doing? There's obviously there's online courses and whatnot. Some people spend time or money going into them, but really I would just say get stuck in, speak to the business, try and apply, see if you get in, or ask a financial advisor for their time. We don't bite. We're always happy to help generally. So if a young person came in and said, look, I'd like to get into this, but I'm not quite sure, I've got a few questions, ask them for a coffee. I'm sure they'll be able to help sort of answer those questions. But yeah, it's a long road. There's exams, obviously. So it's not just come in, work your way up. It's come in, work your way up, and do the exams on top. But it's a great career, and I'd encourage people to get into it. Yeah, the average age of a financial advisor in the UK is like mid-50s, so I'm one of the very few that's currently under 30.
Really?
Yeah,
That's
yeah.
crazy. I
So
didn't know that.
it's an aging profession, so it's a great time to be in the game as a young advisor.
Yeah.
So I would say, yeah, just get stuck in. Don't be afraid to reach out and ask people questions. And I think that's maybe something that holds a lot of people back these days. Is it's easy to hide behind an email or like a phone screen. Try and make the connection. If it doesn't work out, or you think, okay, it's not right for me now, they might remember you in a few years' time when you come back for a job. It's putting yourself out there.
Nice. Yeah. No, I do agree with you. Yeah. Like from the people that I reached out, majority of the people are positive. Like, of course, you have people who don't reply to you and etc. But like, I think the majority of the people are willing to talk for a coffee or like explain to you what they do and etc. And then you can take it from there.
Yeah, people
Yeah.
generally, I think, are inherently good and are willing to help. So just put
Yeah.
yourself out there.
Would you say is there anything I have left out when it comes to investing or debt or like financial literacy? Anything else from your like day-to-day job that you consult with your clients?
I don't think so. I mean, it just comes back to keeping it simple. Don't try and
Yeah,
overcomplicate it. If something or an opportunity sounds too good to be true, it probably is.
yeah,
If you get too caught up in, well, it's going to return me X amount or double your money in a short period of time, it's not. It just it just isn't. So just be careful for those types of things, and anything you're unsure about, do your research. Speak to financial advisors before you go into anything. But no, I think the questions have been very good actually. You've steered the conversation well. We've covered a lot. I'm just looking at the time. It's no, just keep it simple. There's beauty in simplicity. Investing doesn't have to be very, very complicated. I think it has that sort of that stigma to it where it's investing's not for me. You have to have a lot of money. You don't. Just get started and keep it simple, and you'll create a good long term outcome. I'm sure of it.
yeah, perfect. Um, Final question: where can people find you and reach out to you if they want to,
I guess the easiest way is just to Google Executive Wealth Services, and we're in Edinburgh, 21 to 23 Thistle Street. Our details are online. Give us a phone, give us an email. There's a website form. Happy to have a chat with anyone who's been interested in financial advice after this conversation or is looking for financial advice. Yep, just go through that. It's probably the best bet, and I'll get back to you.
perfect. No, thank you so much, and thank you so much for taking the time as well for this interview.
No problem at all. Thank you very much for having me.
No, thank you.